Hello, everybody. How are you doing? I hope you can hear me well. I have to turn some of my speakers off because they're interfering with all this. Let me just get rid of the speaker right now. I hope there's no echo. I'm hearing an echo. Okay, guys. So we're ready to get going. Today
I'm not sure I understand.
Well, can you hear me now? Can you hear me better now? I hope so. Okay. Just let me know. On the right side, there's a place you can do questions. Just give me a response. Tell me, hey, you can hear me. I know you can't hear me well. I really appreciate you letting me know because I can't hear myself, and unfortunately, I hear you perfectly. Thank you, John, for responding. Okay, great. So today we're going to be talking about the topic that I happen to really enjoy, and it's not one that many people understand well, and I'm not going to say I understand it well, but I understand it better than most. And basically, we're talking about a golf putt. How do you get the ball in the hole? Or is it an investment put? I mean, the English language is so funny in the sense they're both the same word, P-U-T. Very, very, very differences, okay? Huge differences about them. So let's get into that in a moment. But first, we have to go through, hello from Vero Beach. There we go. So first, we have to get into some of the fun things that I have no choice, but I have to do, especially because we're going to be talking about investment things. Number one, I am not an investment advisor or an attorney, a CPA, an accountant, or a financial advisor. Nothing to do. You agree that you bear responsibility for all your investment, financial, tax decisions. You agree that me, Robert Holt, is not and will not be liable for any investment, financial, or tax decisions that you may make based upon the materials that are presented today. All material that I have here published that you'll see in these PowerPoints is sourced from various publications that I believe to be accurate and reliable. However, there are no claims or representations as to the accuracy, completeness, or truth of any material contained in the following presentation. Please consult your own attorney, tax advisor, accountant, broker, whatever the case may be. Now, we're going to be talking about options. So stocks and option trading has large potential rewards, but also large potential risks. You must be aware of the risks and be willing to accept them in order to invest in a stock or the options market. And if you have a brokerage account, you're going to see they're going to require you to disclose whatever it is and agree to the terms that they're focusing on and the risks, obviously. Do not trade money that you cannot afford to lose. That's always a difficult thing. We don't know. Look at the black swan we're facing right now. And this is neither an offer to buy or sell or a recommendation of a particular stock or option, okay? So, our dear friend, Mr. Benjamin Franklin, what did he say? He said an investment in knowledge pays the best interest. And I guess that's why he's on the $100 bill. It's really funny. The $100 bill is the largest bill we have right now in the United States. If you go to Europe, in Switzerland, the largest bill is 10,000 Swiss francs, which is roughly, my God, it's almost $10,000. Isn't that crazy? Anyway, so an investment in knowledge, but sometimes a little bit of knowledge is very dangerous. So be careful on that, okay? Because today you're only going to get very little bit of knowledge, so don't make any decisions on what you see today, okay? So what is the recipe for trading disaster? What are the ingredients? Well, here they are. Number one part is lack of knowledge. And it doesn't mean a little bit of knowledge, just lack of knowledge. And even if you have a little bit of knowledge and you think you know a lot, lack of experience. Trading on intuition. I think this is going to go up. Really? You think? What makes you think? Oh, I know. How do you know? That's a very interesting question. So you really have to learn how to read charts, listen to things. Don't listen to CNBC all the time, the talking heads, blah, 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 blah. Once people know about it a long time ago. And the other part is something we're going to call hopium. It's like opium, but you're based on hope. Oh, I hope this is going to go. They call it the wall of worry. There's all different names for this sort of stuff. It's like you buy something that's going the wrong way. Oh, it's going to go up. I hope. Or I'm going to buy something based on, I hope it'll work out. Forget it. This is not religious. We're not going to deal with hope, okay? Now, we're facing today something called a black swan event. And if you've been in other webinars that I've done in the last couple of weeks, I'm sorry for the repetition, but what is the black swan? A black swan event is something totally unexpected, totally unpredictable. It never has happened before, and it's a negative shock, it's a surprise. Where does this term come from? Well, all the swans in Europe were white swans. They go up and down the rivers and the lakes and the castles, wherever. You go to Geneva, you go to London, you go to Germany, heck, you even go to Russia. They're all white. There was no such a thing as a black swan. And then the English explorers went to Australia, and guess what? In Australia, the swans are all black. There are no white swans. So that was a total shock and a surprise to them, all right? So right now we're looking, going forward, the result of this black swan, okay, which has been a terrible kick in the teeth for the economy. Today's unemployment came in at over 4 million. So now we have over 26 million people unemployed. That's amazing. It's probably going to be at least 15% based on Goldman Sachs estimate. I believe we've gone beyond that already. And it says GDP is going to drop 34%. Well, obviously it's going to drop with nothing happening. Let's see what happens when we open. But things are going to take time, and we just don't know what's going to happen. What are we going to be facing in the future? That right now is not a black swan. The black swan is what happened. What's really going to be confusing is, what are your predictions? Some people are saying we're going to go into a depression. Some people think we're going to have what they call a V-shaped recovery. It's going to go all the way down and straight up like a rocket. I don't believe in a V-shaped recovery. I do believe long-term, the United States will do well. So what we need to do when we're going to get into any kind of investment, be it stocks, commodities, whatever, we need a trading plan. You don't want to do anything, set it, buy it, set it, forget it. For example, some people inherited stocks of Standard Oil, which today would be ExxonMobil. If you had Mobil, it's all the same company, XOM, that's the symbol. And they inherited from their grandparents, their parents. Oh, wow, I love Exxon. It pays a great dividend. Today it pays a fantastic dividend. What's the price of oil? It's all the way at the bottom. What are the yield rates, the dividends that Exxon's paying today? It's huge. You can't get that money anywhere. Will Exxon keep its dividends? I don't know. I'm not going to say what I think because that wouldn't be appropriate for me. But I do think very, very high yields are a problem. But today you do have yields that they call them accidental high yielders. They shouldn't be giving that great yield. So you really have to have a plan what you're going to deal. So these are the different things that have to go through your head, okay? And I'm just saying, first of all, you have to have some kind of a system. Based on what am I going to buy, this stock, this commodity, this option, whatever I'm going to do. When do I get in? How do I manage my trade? If I'm losing 10%, do I get out? Oh my God, yes, let me put a stop order in right away. Okay, that could work. What are my exit strategies? Oh, it's going up. Oh, yeah. Well, do I sell? No, I think it's going to double, it's going to triple. Well, maybe, but it also could crash tomorrow. We don't know. What is your business plan? What do you want to do with your investment? What is your trading plan? Do you have a plan per se? What are your objectives? Every trade is a different trade. You need to write down very clear when you enter into something, whatever it is, even if it's long-term. Long-term, I'm going to buy oil because I think oil is great. Well, if you thought that 5 years ago, you're not very happy today. However, if you bought IYW, which is the ETF, Exchange Traded Fund for technology, you'd be very happy despite this drop that we've had. Yes, it came down, but look at it from a few years ago, doing really great, okay? What is your trading style? If you're nervous and you're going to go in every day, in and out, in and out, in and out, don't do this, okay? This is not for you, okay? What are your preferred strategies? Do you prefer options over stocks? What kind of options do you like? What kind of stocks? What's your preferred market? Some people like commodities. Some people like trading money, just simply the currency market. The currency market is the world's largest market. People are continually buying and selling commodities. They're buying the yen in exchange for the pound. You're going to get the Canadian dollar, the American dollar, the euro, whatever the case may be, okay? How much risk are you willing to take? Well, you have to evaluate your risk. And then the other thing is management of your money. That's one of the most dangerous things, and I've made that mistake. I've backed up the truck. In other words, I thought this was so great. I plowed in a fortune of money, and I paid that. I paid that mistake. Never back up the truck. Never think you've got 100% winning, because you don't know. Look at the black swan. Nobody expected this, okay? So when you talk about money management, how are you going to invest? What are you going to control? How much am I willing to risk of my total asset values, okay? I recommend you never risk more than 5% of your investment portfolio, and even that could be too much, okay? Depending on how big your investment portfolio is, but that could be too much. Okay, so what are we going to do today? We're going to talk about something I'm going to call a very simplified trading plan. When I mean simplified, it's that there's a few simple steps. Number one, we have to spot the opportunity. Think about the opportunities that are out there. I remember one not too long ago when Deepwater Horizon, the BP, remember they had that horrible thing, these people died on the rig and there was oil all over the place, and Obama said he's going to put his foot on the neck of BP and blah, 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 and BP dropped terribly. I thought, you know what, BP is one of the most important British companies that exist in England. All the pension funds have them. Freeze down on their dividends. I thought, you know what, it'll come back. To me, that was an opportunity. It was a mistake. It was terrible. What happened? But be it as it may, there was something that we could do about it, and I did buy it. Unfortunately, I still have it, so now I got the black swan that came. But anyway, so we got to create what is called a low-risk trade. How can I minimize my risk? And to a degree, options can help you minimize your risk, so we'll get into that in a while. And then I have to plan what I'm going to do, and I have to execute it. When I say execute, when you place an order to buy something, you could say, give me that market. What does market mean? Whatever's happening in the market that time. Could you get a better deal? Oh, yeah. You can put a limit order below the market. You've got to decide how are you going to execute that trade, how I'm going to go let the money go out of my account, and in exchange for giving somebody money, I a commodity, a share, an option, or something. And then I have to manage. It's not set it and forget it. Set it and forget it could be, doesn't mean it will, it could be a recipe for disaster. I know people who bought Apple many years ago. They set it and forget it. They're loving it. Great, great. But you know, not everybody bought Apple many years ago, okay? So we don't want to set it and forget it. So let's get into some simple definitions, and they're not that simple. There's something called a put option, and there's a call action, okay? Now, when we say they're different, they're basically one of the same, but they're different, okay? So what is the put option? The put option is a contract that gives the owner, the person who's buying the contract, who's taking, literally forking out his money, or their money, the right, but not the obligation, to sell this commodity, this underlying security, at a predetermined price within a specified time. And I'll give you an example. One that I did on my Facebook Live. And I'm going to make it so simple. We're going to go to a different industry called life insurance. And let's just say you want to have insurance because God forbid something happens to you, you want to be sure your family's well taken care of. So you buy $1 million term, okay? And it's going to cost you $50 a month. Well, it costs if you're relatively young and good health, okay? Maybe it costs even less than $50 a month. So let's just say it's $50 a month. When I pay that $50, okay, I'm buying the right, not for me, but for my family, that should I pass, they're going to get the money. So I'm the buyer of that right. The beneficiary is my family. So basically, I'm putting my net value. I'm making a bet. But I'm saying, oh, wow, I think I'm going to, if I need this, it's going to happen. And the insurance company, obviously, they're going to check me out and everything else. They're going to say, nah, you're not going to die in this period of time. So we have two sides of the coin. Somebody's buying, somebody's selling, okay? If anything happens to me, they have no choice other than to pay. So let's put it to a stock. Let's just say I own ExxonMobil, and I owned it before this crash. And I don't know what the price is at. I can look at it, but I'm not going to waste my time right now on that, because we got very little time in this seminar. Let's just say ExxonMobil is at $50. And I'm saying, wow, what if it goes down? You know what? I'm going to buy a put to protect myself. I'm going to buy the $40 or $1. What does that do? Since I'm buying it, and I'm going to give myself, let's say, a 3-month period of time, so it costs me $1. If it goes down, I can force the person who, remember, I'm buying it, the person who sold me the put, they're going to have to buy it at 40. I have the right, not the obligation. So let's say I have the $50 stock. I sold the 40 put. The stock went up. What's going to happen? I'm not going to sell it at 40. I'm not a fool. So I lost my money. It's like insurance, okay? But let's put it at 50, and I bought the 40 put, and the thing went down to 20. What can I do now? I can sell it at 40. I can minimize my risk. I could have even sold the 50 put, which would be more expensive. That's called at the money. Trading at 50, I sell the put at 50. And it goes down, I could say, oh, you're the guy who I sold it to. You bought the put. Yes, I mean, you sold the put. Okay, then I have and you have the obligation to buy it. Okay, so there's rights and obligations. Let's go to something a little easier that some people understand, which is the other side of the coin. It's called a call. The call gives the buyer the right, not the obligation, to buy an underlying security at a specified right within a period of time. Let's bring it to what happens in Miami, that people buy houses. Okay, most people have bought an apartment or a house, something, all right? So let's just say you go into the neighborhood, you like this house, you say, I really like the house, I'm going to write up a contract, it's the word contract, and I'm going to put some good faith money. That good faith money means I have the right to buy that at the price that we agreed. There's all these specified period of time. Within the next 3 months, that's the closing date. I have the right to buy that house at X price. I have the right, not the obligation. When the contract is written, it goes to the seller. The seller either accepts my offer or doesn't. When the seller accepts my offer, that seller has no choice other than to deliver the house at the date, at the price that we predetermined. But let's just say right now, in fact, I was speaking to a friend of mine. I don't want to mention his name. I was in a webcam with him earlier today. And webinar. No, it wasn't a webinar. It was a Zoom meeting. Sorry, Zoom meeting. And he told me he was going to buy an apartment. And he saw this crash. And he said, you know what? I just walked away from the contract. He has the right to buy the apartment he bought a call option on. He put some good faith money in a contract. He said, I don't want it anymore. Forget it. What does he lose? His good faith money. Person who wants to sell the house, what could they do? Nothing. Just keep the good faith money. So a call option kind of works like that. There's two sides. Somebody sells the call, somebody buys the call, okay? So a call option basically gives the buyer the right, okay? Somebody buys my call option, the right, but not the obligation. So if I think, for example, let's just look at ExxonMobil. I don't know what the price is. Let's say it's down to $10. And I say, you know what? If it hits 15, I'll buy it. Don't know if it will hit 15. But how am I going to do this? The guy who owns it at 10 will say, you know what? I'll sell a call. I'll sell an agreement to sell it at 15. I'll buy it because I'm willing to pay the 15 in the future, 6 months from now, for example, okay? So the guy who owns it at 10, he's going to get a premium to sell it at 15. 6 months from now, it hit 14. Am I going to buy it? Well, guess what? I have the right to buy it at 14. Remember, I bought the call. Okay? But I probably would not. Why would I buy it? why would I pay 15 if it's at 14? I have the right to buy it at 15, not at 14. Why would I buy it? But if it was the other way around, if I owned Exxon and I sold at 15 and you bought the right to buy it at 15, and 6 months from now it's at 20, guess what? I have an obligation to give it to you at 15, even though it's at 20. Okay, so that's the call and the put. Very similar, a little bit complicated, okay? So why on earth would anybody in their right mind want to trade options? Well, let's talk about that a bit. Number one, oh, sorry, I didn't move down. There we are. Number one, it gives you control and leverage. What do I mean by control and leverage? One option lets you control 100 shares. So I could buy an option for $2 to pick a number. But for those $2, I have the right or the obligation, whether I bought a call or a put, whether I sold it or bought it, but I have certain control over 100 shares. I can have the right to buy it or to sell it, depending on where is the call and put, whether I bought or sold, okay? So it gives you sort of leverage. So with the minimum investment, you have rights and obligations going forward. But if you're on the right side, I have the right to do something. But guess what? I have a right to protect myself. If you had a lot of puts that you bought before this crash, you could have, if you bought it, you have the right to sell something at a price. You could have forced people to buy ExxonMobil at $40, even though it's at 10. Why? Because you had the right, okay? So it gives you leverage, okay? And it also gives you the next word, which is protection. All right, so there's that two words are kind of controlled, combined, but not always, because I can control, because I can take the other side of the coin, which is I want the right to buy ExxonMobil 2 years from now or a year from now at a certain price. I can buy that right. It gives me the control, gives me the right, not the obligation to buy 2 years from now. And if I don't do it, I'll lose a little percentage, okay? It can also help you pay for protection. Now, why don't they pay for protection? Well, this is funny. It's called offsetting options. Let's just say, for the fun of it, that I had ExxonMobil, and I wanted to protect myself. Okay, so I had, is that 50? Like we said earlier, I'm going to sell the 40, right? So I'm going to get some money. Actually, I'm going to buy the 40. Excuse me, I'm going to buy the 40 so I can force you. I'm going to buy the 40 put. I can force you to buy the 40, okay? That's going to cost me money. Well, what can I do? I can sell a call above, meaning I'll give the right for somebody to buy the 60. That'll give me money. In the other case, the 40 will cost me money. One offsets the other to a certain degree. We're going to get into this offsetting in another webinar next week, okay? The other thing we can do is generate income streams. Oh, wow, what does that mean? Well, there's something that they call covered calls, okay? What is a covered call? I own ExxonMobil. I got it at 40. Oh, I get a good dividend. Guess what? I want some more revenue. I'll sell the 60. That's 40. I'll sell the 60. I'll sell the 50. That gives me money coming in. Great. Or guess today, oh my gosh, I could sell what they call naked puts. I don't want to get into that too much, but I could sell a put that I don't own. And that's going to give me an income stream. There's always a risk, okay? It's easier when you do it. It's called a covered call. I own the stock. I sell a call higher. Guess what? The stock goes up. Well, I'm going to get the premium, and I'll be able to sell it at a higher price, all right? But we'll get into those details later on, okay? So let's talk about the big threes of options. There's three very important things you got to look at. Number one is the strike price. What do I mean the strike price? That's the price at which time the buyer has the right to exercise his right, okay, their right. The seller has an obligation. So if I bought a call at $40, if it hits 40, I can buy it at 40. Doesn't matter. That's the strike price. If it hits 39, I can't force you to sell it to me. Why wouldn't I wouldn't dream of buying it at 40 if I get it at 39. Okay, so the strike price is the price which you're negotiating the buy-sell agreement. It's almost like the price when you go to buy an apartment. You agree on a price between the buyer and the seller. That's the price. That's it. It's done. At the closing, you've got to give the person what you agreed to pay. Okay? That's what it is. Expiration date, very much like an apartment or you're buying. When you're buying an apartment, you put a closing date into the agreement. You want to buy that apartment, that person wants to sell it. Well, if you want to buy it, you want to close within 3 months. And if it's not ready in 3 months, what's going to happen? Well, those things are very interesting, okay? So we have dates. When will it expire? Most options expire worthless. What does worthless mean? It means if I'm selling a 40 call and the stock's at 20, but it never hit 40, at expiration, it's worthless. Why? Because nobody's going to pay $40 for something that costs less than 40, okay? And then there's rights and obligations. Remember, the person who buys something, just like in a house, I want to buy a house. I put goodwill money down, or good faith money. If I change my mind, I'll lose the good faith. In the case of an option, when I buy an option, either a call or a put, I have rights. I have a choice. The person who sells the option has only obligations. They must deliver, be it a call or a put, but they must deliver, okay? So let me go into a little bit of explanation, okay? Strike price is agreed upon transaction price between the buyer and the seller. That's what I said. We agree, we're going to buy something. So let's say, for example, we're going to have a $25 strike price. And the buyer of the call, the guy who buys the call, may buy 100 shares of that company at $25. He bought the call. He has the right to buy it at $25 if it hits 25. Even if it doesn't hit 25, he still has the right to pay 25, but it wouldn't make sense if it was 24. Why do you pay 25? Okay? And the person who sold that call must sell the 100 shares at that price. There's no choice. You sold it. You made an agreement to deliver the 100 shares at that price. You have to deliver. Okay? So let's just say, for example, in the case of the $25 stock price, the share goes to $50. Wow. The buyer, the guy who bought that option at 25, what's he got to do? He just pays $25 for the share because that's the option he chose. That's the call he bought, the $25 call. The fact that it went to 50 doesn't matter. He pays 25, and he has what we'll call an unrealized profit of $25 a share until he sells the shares. If he could sell the share immediately, then he made that additional $25 profit. But in his bank account, until he sells the shares, he's got an unrealized profit, meaning he hasn't sold his shares. He still owns them. He paid $25 for them, put the shares in his pocket, cool. Or he could pay $25 for them, immediately turn around and get rid of them. Then he's got the $25 profit. Okay. So when you exercise your profit is a different question. All right. So expiration date. Most options trade with options that will expire within 30 days. Okay, when I say 30 days, they're generally the third Friday of every month. Some ETFs, some indexes trade the third Thursday, but let's just say third Friday just to make life easy of every month. And you have expiration periods of, let's say, the third Friday of May, June, July, August, September, October, November, December, okay? So you can buy 30 days out, 60 days out, 90 days out, you know, as far as you want. There's also something called a leap. Leap means jump ahead, far ahead. Leaps generally in people's minds start 9 months out, okay? But you can even get stuff that's 2 years away. Somebody asked me today, this morning actually, they said, hey, do you think it's a good time to buy cruise lines? I don't know. That's an interesting question. I mean, when do you think the next cruise is going to go out and how many passengers do you think you're going to have? I mean, from what I understand, Carnival's not planning to do any cruises until August at the earliest, okay? Now, would you want to get on a cruise? Depends. If coronavirus is still hopping around, maybe not. We don't know, okay? But will it be here 2 years from now? Well, maybe you could buy RCL, which is Royal Caribbean Lines, or Carnival, CCL. I'm not recommending it, okay? It could go down further, right? I don't know, all right? But knowing that, you could say, you know what, I'll run a flyer, whatever. I'm going to buy 2 years out. You can do that, okay? Up to 2 years. And some, I don't know about RPO, but in many stocks you can do that. There's also short-term things that expire every single week. That's a very, very active trading company. So you can buy things. Today's basically Thursday, but you could buy something expiring next Friday. Okay, so you have 8 days time to make or break your money. So you have weekly options too. But in this case, the people listening to this, whatever, you guys do not want a weekly option. All right. Okay. So we're going to talk about the rights and obligations. Remember, the rights of the option has the right to buy the underlying stock at the stock price. The buyer of the put has the right to sell. I can put it to you. It gives me the right to put it to you. That's the word put comes. Or I can call it, bring it to me. So if I buy a put, I have the right to sell. And if I buy a call, I have the right to bring it, the call, okay? And as I said, most rights expire on the third Friday of every month. The seller, on the other hand, the seller of an option is called a writer because they kind of agreed to sell it, okay? They have the obligation to sell the underlying stock at the agreed upon price. So if I sell a call, let's say I own, say this crazy product, buy. I don't know if it's good or bad. I don't even know who makes it, but I'm drinking it lately. Okay, so I say, yeah, this is really cool. It sells at $20. I'll buy the stock and I'll sell a call because I want to make more money at $25. Well, the moment I sell it, I have the obligation to deliver it at $25. Now, if my call only hits $24.95, the guy on the other side who bought it is not going to buy it for a nickel less. Why would he? He buy it in the open market, so I can keep that premium. On the selling of a put is the other side. When I sell a put, I'm basically promising that I'll let you put it to me. In other words, I'm promising to buy it. So when I sell a put, basically, wow, I'm saying, I think the stock is going to go down, and I'm willing to buy it at this low price. If it comes down to here but doesn't hit the lowest price, I get to keep the premium. That's cool. Okay. So these things also, like I said, they also expire. And the buyer, remember the seller, the buyer has the right to exercise their right anytime before expiration. Now, this is interesting before expiration. Let's just say I sold a call for 3 months from now. Let's just say I sold buy. They buy selling at 10 and it's doing really well. I don't even know sell, but anyway, selling at 10 and I'll sell 3 months from now at 20. And 3 weeks from now it hits 20. Well, the guy who bought because remember I sold the call to buyer. At that moment, even though we have not reached expiration, the guy said, "Give me the shares at 20, I'll take them because I think they're going to go higher." I have no choice. Even though it's a 3-month period of time to call, the buyer has the right to buy the stock any time before it expires. Okay. That's very, very important. Oh my God, I'm sorry I didn't bring it down. I thought I was just talking about it. I'm sorry. Okay, so there's buyers and sellers of these programs. All right. So as I said earlier, most people have used options without even knowing them. If you bought a house, you first had a call option. You had the right. You made an offer subject to terms and conditions, price, closing date, revisions. You're going to say, okay, let's check the house out. They'll accept, $2,000 of repairs. You give good faith money. You wrote a call. The moment you did that, you wrote a call. And the seller, okay, what did the seller do? Well, actually, you bought a call. The seller wrote the call. That's my mistake. Okay, well, the seller accepted the call to buy the home. If you back out, you lose your good faith money. But the seller must deliver the house. And in insurance, which is the next example, if you bought a life term policy, whatever it is, you bought an option, okay? You're basically saying, if I die, my family's going to get the money. So it's a put option on myself, all right? And basically what I do, I pay a premium. By the way, when you talk about option prices, the word is premium, because you're really buying a right, which is what this is doing. When I sell a put on myself, okay, I am basically doing what? I'm not selling a put, I'm buying a put. Why? Because I'm paying money. And the insurance company has the obligation to pay upon my death. So you basically have a put option on yourself. You paid the premium. If you pass away before the expiration date, which is the term of the policy, policies last so long. They last, term policies last 10, 15, 20, up to 30 years, okay? Your family get the benefit. Now, remember, you got to pay every month. I know this one lady, and I don't want to get into it too much, but her husband became very sick. And guess what? They didn't have their premium on automatic debit. And he was sick for a couple of months, and they forgot to pay the premium. They didn't pay the premium. What happened? The insurance policy was canceled. Okay, but let's take another position. Let's just say the gentleman not only was sick, he got better, he lived, and he's still alive. But they had a 20-year term, and the term expired. The moment it expired, there is no more obligation. Okay? It's important to note that. Very, very, very important difference. Okay? So, as I said earlier, options are sold, and the value tender is called a premium. I said before. Now let's look at a long stock. When we say the word long, what that basically means, I bought a stock. Okay, I'm long. When you're long the market, it means you believe the market's going to go up. You buy the market. You're in the stock. Long stock means you buy. So stock prices here, we're just saying they can be very low or very high, and at one stage you're going to have a profit or a loss. So let's go through this and see what happens. Okay, so in the very first example, let's just say we buy the stock around here, okay? And as long as the stock stays, I'm breaking even, right? I paid it $50, it's still $50. But as it goes up, I have unlimited reward. Let's say I bought, I don't know, Facebook at $10. Well, that'd be really cool, right? Or any of these companies, Amazon, whatever. Okay, I mean, up all these years, right? Well, I didn't do it. So we have an upside, right? When you buy a stock, you have an upside. You also have a downside, because once it goes below my break-even, my cost, I have unlimited risk to zero. Why zero? Because companies have gone broke. Okay. So when you buy a stock, you can break even, you can make money, or you can lose money. Okay. So the line here, this dotted line, is my cost, which time my cost is, okay? I put here the break-even point, which means that's the price I paid it at. As long as I'm above, I'm making money. If I'm below, I'm losing money. But if I'm at the money that I paid it for, then I'm breaking even, okay? So the stock value goes down, and the stock price goes down. I'm going to lose, and the stock price goes up. I'm going to make, okay? I think everybody understands that. Not too difficult to say that. So let's look what happens when you go short stock. Did this go too far? I really can't see it. I'm sorry. Let me have a look here. Let me go back one. Okay, I think that's back one. Okay, so short, exact same thing. So what happens when we go short the stock? Short the stock, what I'm basically saying when I go short is I'm selling a stock I don't own. Okay, why? You say, what? You can sell something you don't own? Yeah. You got a brokerage account, you can sell anything you don't own, provided you get the money to back it, okay? So let's just say for the fun of it, when the market crashed, before it crashed, you said, I think oil's going to crash, but I don't have ExxonMobil. So I'll sell 100 shares. How do I sell 100 shares? I put an order to sell 100 shares. You have to have what's called a margin account, which means the stock brokerage firm will lend you the shares, essentially lend you the money. So if ExxonMobil is at $50 and you want to sell 100 shares, 50 times 100 is $5,000. You're out of pocket $5,000, but they're lending it to you. They're going to charge you interest, of course. Now, if the price of ExxonMobil went down and you sold it here, you didn't own it, but you shorted it. Okay, it's called short of stock. That's why long is when you buy, short is when you sell, especially when you don't own it. Okay, so if I sold it at 50 and it went down, what happened to my profits? They went straight up. So that's cool. But guess what? Some people think that the price is going to go down, but it went up. I remember years ago, I thought Target, I can't remember what it was, going to go down. So I shorted it. It went up. Okay, and what did happen? I lost money. And then eventually I had to return the shares to actually the money that I owed, which basically means I had to cover my short. What does that mean, cover the short? Let me step back. Let's just say I sold the stock that went up, say Target a couple years ago, okay? I don't own it, but I'm negative, meaning I borrowed it. So if I sold it at $5,000 and I got $5,000 in my pocket, but now it went up, so to buy 100 shares, I need to buy, let's say instead of $50 a share, $75 a share. I got to put 7,500. Well, if I borrowed 5,000 and now 7,500, guess what? I lost 2,500. So there is what we call an unlimited risk, unlimited to zero, the bankruptcy, okay? If the price goes up. Well, it's not going to be bankruptcy, it'll be your bankruptcy. Because if you shorted the stock and you don't have it, you're going to go bankrupt, okay? Let's just say you shorted Apple a couple of years ago and you're still short. Wow, you'd be in deep trouble today. That's the unlimited risk, okay? But you have to have the assets to back the loan. The moment you don't have the assets to back the loan, your stockbroker is going to say, thank you very much. Give me the money, okay? And if you don't have the money to close the position. So let's look at what happens with a long call. What's a long call? A long call basically means I think this company is going to go up. But to buy, let's just say, I don't know, Google. What's Google say? Oh, no, Google's very expensive. Let's just use another example. Let me look here. Just any old company, really doesn't matter. How about AT&T? Okay, it sells about 30 bucks, okay? And I think AT&T is going to go up for whatever reason. Everybody's using webinars, who cares, okay? So I'm going to buy a call. I don't have, well, I would have $3,000, but let's just say $30 a share. One call is what? $30 times 100 shares is $3,000. I would need to have, if I was going to buy 100 shares, the shares I'm going to buy at the call. So basically what happened is, here's my strike price, okay? This is what I'm going to pay for it. I'm going to say, this is the price we're going to agree. We're going to agree on the $30 call. I'm going to buy the call because you buy it at 30. So if it goes the other way, I'm going to have the right. I don't have an obligation. So I only have the right to buy that call. If it goes the wrong way, I'm only going to lose the money I paid for the right, the premium, okay? So essentially, that you at the strike, at the money, we're saying the shares at 30 bucks. I'm going to buy a call. That's really cool. So what's going to happen? Well, I have a limited risk because if I bought a call, and let's say over here, I bought my strike price. Well, over here, there's a point at which the cost of the premium, okay, the premium I paid, let's say I paid $1 a share. Okay, so but really my break even is the 30 plus that $1 that I had to pay for the right to buy it. So that's my limited risk. What can I lose? Well, I can lose what I paid, and as the price goes up, meaning if it hits 31, I wouldn't be too bad. There's a little gap in there, okay? If it goes that way, it doesn't mean I'm going to make a lot of money. But the moment it goes past my cost of the cost of the share plus with the premium that I paid, that's when I'm going to start making money. But if I pay $1 for a $30 call, my break even is at $30 plus that one that I paid the premium, 31. That's why I break even. Am I clear? So if I buy a $30 call, I paid $1. The company has to go to 31 for me first to break even. If it doesn't hit 31, if it hits 30.99, I'm going to lose a penny. If it hits 30 and whatever, 50 cents, I'll lose it 50 cents. If it goes down, I'll lose the full dollar that I paid for the premium. But once it goes above that point, guess what? Woohoo! Unlimited reward, okay? So that's the way it works. So there's two numbers we talked about, which is or two areas we talked about: at the money, in the money, and out of the money. What is it? If the company is selling at, let's just say here, if the stock price is $30 and I buy an at the money call, meaning I'm buying the $30 call and it's selling at $30, I'm going to have to pay a big premium, right? Because it could go up. Nobody's going to give me the right to buy a $30 call, and they have the 30 unless they're going to get some money for it. They're not going to sell it to me for free. So they may sell it to me for $1. So I'm willing to pay $1 to buy a $30 company at $30 because I think it's going to go higher. Okay, so this is the at the money. When it goes, if the stock goes below 29, below 30, it goes to 29, then it's out of the money. I'm not at what my strike price was. Okay, so I'm out of the money, and I'm in the money when I'm above my strike price. Okay, these are terms. Don't worry about them too much. Later on, we'll explain about the in the money and the out of the money, but it really depends where you want to be, okay? But the important thing on a long call, meaning I expect the stock to go up, I can buy the $30 call thinking it's going to go to, say, 40, and I'll pay $1. Or maybe I'll pay $2, okay? 30, I'll pay $2, 32. That's my all-in cost. Well, I'm hoping it goes to 40. Maybe I can make $8. I'm going to make some what? And the $2 I invested because I never invested the 30. Okay, $8 on $2. That's a tremendous return on investment. When you say this, it's a 400% return. So that's one of the reasons why you can make a lot of money with options. It's also one of the reasons you get wiped out too. Okay, so let's move on to the other one, which is we're going to call a short call. Okay, a short call. What is a short call? The short call is short call. I'm selling a call. And here's an example of what I can do. Let's just say here we have again AT&T sells at $30. That's the strike price. That's the at the money strike price. The stock's at $30, and I'm going to give you the right to buy it at 30, but I'm going to sell it to you for $2. So you have the right to buy the 30, but it's going to cost you $2. This isn't the future, okay? And you're going to say, you know what? I'm comfortable with that because I think it's going to go to 40. All right. So what is my profit at selling you that call? Well, when I'm short the call, I can make $2. Now, if I have the shares, which is what I need to do, I would only sell if I have it. Okay. So what are we going to do? We're basically saying the most I can do if I'm going to sell a $30 call on AT&T for $2, the most I can make is $2. Why? Well, how much? What did I get? $2. Do I have any rights in anything? No, I sold it. I have the obligation to give them the share for $2. What some people will do when they own shares, they'll sell what's called covered calls. We'll get into that later, okay? But I have a limited reward. It's the $2 I got. I sold it. I got the $2. But what happens if I sell the call? And all of a sudden, the price goes up a lot. Remember, I'm selling the call because I'm not thinking it's going to go up. You're buying the call because you think it's going to go the other way. Well, if I sell it $30 for $2, my theory, my break even would be $32 because once it hits 32, that guy, the buyer, has the right to say, give me the shares. So I got to put the $30 for the share plus the 2 that I got. That's my money out. I've lost it, right? Because it's 32. But What happens when I have a covered call, and it's a short call, excuse me, and the price goes way, way, way up? I have literally unlimited risk. I can go broke. So the short call, you never did. This is basically called short call. It's also called a naked call. Why naked? If you don't own the shares and you're selling a call, your stockbroker is going to say, hey, you have to have a lot of money here, because if it goes up, who's going to be able to pay the difference? Because remember, if I sell a 100-share option, a call, I have to deliver the 100 shares. If the price goes way, way up, I have to buy the 100 shares to give it to the person who bought the call. So I have unlimited risk. That's why people do other things when they own the call, own the share, they will sell it. That's called a covered call, not a short call. The same thing, but I own the share. I own it. I don't think it's going to go higher. I'll sell it at a higher price. If it gets to that price, fine. I'll make more profit. I hope it doesn't. I want to do that every single month. Some people will do that. Some people won't. I don't know. I don't know what to recommend. Don't recommend anything. Just telling you the different things, the different choices that there are. But when they say naked means you don't own the shares and you sell the call. And they have a little saying that says you can trade options naked, but never trade naked options, meaning that you don't own them. All right. So that's that unlimited risk that we talked about. If it goes the wrong way, if it goes higher and higher and higher, your broker will be demanding a lot of money. Now let's talk about a long put. Oh boy, there's so many terms. What's a long put? A long put means I own the shares, or I may not own the shares, but I think this company's going down. Let's take American Airlines, okay? When this mess started, was the perfect time to sell a put. Because, oh my God, people aren't traveling. I mean, it started, I'm saying, in early January, okay? If these airplanes don't fly, forget about the salaries. The most expensive thing an airline has is the depreciation on that airplane. And if you're leasing an airplane, do you really think the company that's leasing the airplane cares that you don't pay? Forget it. You got to pay. Okay, so a long put means I'm going to buy a put because I anticipate that this stock is going to come down. So I want to be able to sell it to you, gives me the right to sell. And you who bought, if I bought the put, you who sold me the put, I have the right. You have the obligation. Okay, obligation. So let's move on. What happens when I sell the put? Well, when I sell the put, it basically happens, I have limited risk. Sorry, when I buy a put, I have limited risk. Why? Because I paid so much money. If it goes the other way, I'm okay. Now, what happens if I sold American Airlines and that price went down, down, down? I'm going to be giggling. Why? Because if I sold American Airlines, but I bought a put to protect, the concept of buying a put, if I want to be able to sell it, I buy that put, and the stock price goes down, I'm going to be giggling. Why? Because I have basically an unlimited upside. It's going to go up and up and up and up and up. That's really cool. Okay, so now we're going to do short puts. Short puts, these are very dangerous. If you remember, short is naked. You don't own the company. You have nothing there other than you're basically saying, hey, I think this stock is, if I'm selling a put, what do I think? Think about it in 1 second. Selling a put. I don't think the stock is going to go that low. Okay, so what's my break even? My break even is, let's say American Airlines was at $40, and it goes, my put was $2, so it's at 42. No, 38. It's 40, went down $2, 38. If it hits 38, I'm still breaking even. If it goes down to 10, I am in deep trouble. Why? Because remember, when you buy, you have the right. When you sell, it's the short, you have the obligation. Now, when would you use a short put? You could use a short put on a company that you don't think is going to go that far down. You say, I'll sell it. I'll give myself the obligation to buy it at a low price. Let's just say ExxonMobil for the fun of it. Let's just say it's selling at $12. And you say, you know what? I'll sell the 8. If it hits 8, I'll buy it. I don't care. If it doesn't hit 8, I'll keep the premium. Okay, so you have to, if you're going to sell something naked, meaning I don't own that share, at least I have to say I'm willing to buy that share at the strike price. And the strike price is going to be much lower than what it is. All right, so we have to look at what is the risk. If I'm selling the put, as long as I'm breaking even, I'm okay. And guess what? If I'm not breaking even, I have to say, you know what? I'll buy it anyway. Take Disney World. Okay, Disney just got through furloughing 100,000 employees. 100,000 employees. How many people are going to Disney Park? Nobody. Could Disney go down further? I don't know. But when you go back 2-3 months ago, you could have sold a put and say, I'm willing to buy Disney. Say it was at 100. I'm willing to buy it at 50. And guess what? If it's at 50, you're breaking even. But if it's lower than 50, you're making money. Okay? Or you may just say, you know what? I'm happy to buy it at 50. Give it to me. I don't care. Okay, so we're basically ready to end. I'm going to just say one more thing. This is the disclaimer I said at the beginning. The most important thing is what's on the bottom. Stock and option trading has large potential rewards, but also large potential risks. You must be aware of the risks and be willing to accept them in order to invest in the stock or options market. Do not trade with money you cannot afford to lose. This is not an offer to buy or to sell or recommendation of any particular stock. I wish you all a lot of good luck as we go forward. I wish you all the best of health. Thank you for attending this webinar. I'll have a video of this up. I always say tomorrow, but I'll probably do it within the next hour or so. If you got any questions, you can email me at rbull.miamirotary@gmail.com. I have a Facebook page. You can look me there. And I have my YouTube channel. It's best fun. When I send out the video, you can always click on it, the YouTube channel that I have. But my YouTube channel, Spetsbucks is really hard to find. There's tons of other Spetsbucks. Or you can look short URL.at/b capital DGMT, and you can see all my videos there. I really want to thank you for participating in this webinar, listening to it. A bunch of people had to freak out. They're probably scared what I've been talking about. I'm sorry. I hope I didn't scare you guys. It's interesting market, interesting times. And, you know, that's funny. There's a Chinese curse. And the Chinese curse is, may you live in interesting times. Well, I'm just going to say, I wish you the best of health throughout all this problems. I hope you and your family stay healthy. And I want to wish you all the best as we go forward. So thank you very much for participating. And I'm now going to, let me see what I put here. Exit webinar. Where is it? Right here. Okay, and we're going to say bye-bye. Sayonara. Thank you. I'll see you. Oh, by the way, next Tuesday, my webinar is going to be slightly different. We're going to be talking about options on Thursday, but next Tuesday, we're going to talk about international marketing. So thank you.